Hi, my name is Rick Vaughn. I'm the managing director of the Mid-America Angels, which is a local angel group here in Kansas City. We are the oldest and largest angel investor group in the region. We've been around for about 10 years. We started in 2006. We had about 20 members when we started, and we've grown to over 120 investors today. Well, angel investing typically talks about folks that are investing in early stage or startup companies. So these are often companies that are very early in their life cycle. They may have completed what we would call a minimum viable product. So think of that as kind of version 1.0 of their product or service. And they may have a few customers that are paying them for that product or service. But they are still burning cash. They are not at a point where they are cash flow break even yet. And the angel investors themselves, I think it's probably helpful to understand a little bit about who they are. These are typically individuals that are investing their own money. Most times they're referred to as accredited investors, which simply means it's a Securities and Exchange Commission definition, where the investor has to either have a high net worth, which is defined as $1 million or more of net worth excluding their primary residence, or they have to have a high annual income of $200,000 or more annually, or if their spouse also is employed, it would be $300,000. But these folks typically like to invest in local or regional companies. And as I said, they're investing their own money. They are looking for fairly high rates of return because this particular asset category is pretty high risk and pretty illiquid. So those are the folks that are doing it. They can either operate on their own, invest on their own directly with the entrepreneur or the company, or more and more today, we're seeing that they operate as part of a group. Like Mid-America Angels, where they basically work together to look at and vet these particular opportunities before making an investment. Well, this is the type of financing that usually works best for a company that is growing rapidly and has a scalable business model. So think of it in terms of a company that is probably, they may have very little revenue today, but they have the ability to grow and scale to the point where they may have 20 million or 25 million or more of revenues within, let's say, 5 years or so. The other example of a type of company it's appropriate for would be a company that is working on a very disruptive technology that might be worth millions of dollars to another company. And I think one of the things that you have to understand and appreciate is that, again, when the investors put their money into these type of deals, they know that it's going to be a while before they get a return on their investment. So the other area where you need alignment between the entrepreneur and the investors is just having an understanding that the business is really being grown and built to the point where you're going to sell it at some point down the road. And usually that's within a 5, 6, 7 year period of time. And again, when the sale of the business occurs is really when the investors get their return on investment. The type of business that it's probably not appropriate for would be what I would refer to as more of a lifestyle business. So think of that in terms of maybe a single owner that may be serving a smaller group of customers. This could range, the business might be generating anywhere from a few $100,000 to a few million in annual revenues, but that particular business owner is not really looking to aggressively grow the business, and they maybe aren't thinking about an exit. They may be planning to run that business for the next 20 to 25 years. So if the lifestyle business is the kind of business you have, then angel investing is probably not appropriate, whereas, as I mentioned earlier, if you have a business that's growing and scaling, that probably is more appropriate. Well, there's a lot that goes into this process. So I think from a preparation standpoint, there are a number of things they need to think about. Certainly starts with having a fully fleshed out business plan. Most angel groups will have a website where the owner can apply for financing. They go in and fill out an online application. And usually as part of that online process, the angel group will also request at least the executive summary, if not the full business plan. So you need to make sure that you've prepared for that. The process itself, the thing that I would tell any entrepreneur or owner that's thinking about this type of financing is that you're really looking at a process that could take anywhere from 3 to 6 months from start to finish. There are a number of steps that you have to go through. Most of the time, as I mentioned, that starts with an online application. Once you've submitted that application, the next step usually is that you'll be contacted by the angel group, and a meeting will be scheduled either in person or over the phone. And usually at that point, you're talking to 1 or 2 of the angels in the group, and they're really kind of doing what we call pre-screening. They're evaluating the opportunity to see if they think it's an appropriate fit to put in front of the broader group. And that then is the next step. If you pass muster at the pre-screening, then usually the next step is that you're asked to come in and present in front of the full angel group. And again, process may vary from group to group, but to give you an idea, with Mid-America Angels, if the entrepreneur comes in to present to us, they have 15 minutes to do their presentation, and then that's followed by 10 minutes of question and answer. So usually about 25 minutes to run through the whole presentation piece of it. If they pass muster at that point in time, then usually the next step is what we would call due diligence. And at that point, the angel group is going to be asking for certainly, if they haven't before, they're certainly going to ask for your full business plan at that point in time. They're probably going to do a background check on the entrepreneur, on the management team. They're going to really look very deeply at the business itself. They'll look at the financial projections to see whether they feel those are reasonable or not. They may want to talk to some of the customers. They're going to want to meet the rest of the team, and on and on. It's a fairly in-depth process, and it usually takes 30 days or so. Following the due diligence process, often the entrepreneur is asked to come back to present again in front of the angel group. And at that point, they're really being asked about any of the issues or questions that came up as part of the due diligence process. The other thing that often happens during the due diligence process is that one or more of the angels is working with the entrepreneur, negotiating the terms and conditions of the investment. So it's often you come out of that process with something called a term sheet, which really kind of defines what the terms and conditions around the investment will be. And then following that, usually you will get an investment closing within a couple of weeks. So again, that entire process from start to finish can take you about 90 days. So there's a lot of preparation work that your typical entrepreneur needs to go through before applying for funding. Well, I think the advantage of it is that you can raise a fairly large sum of capital. Typically, again, the type of company here that we see is usually looking to raise somewhere between $500,000 and $1.5 million. And so you can raise a fairly significant amount of capital for an early stage company by going through this process. And I think the other thing that you often see is that there's not, most of the angel groups do not have any sort of an application fee. Occasionally you'll see one that might have a fee of $100 or $200, but a lot of groups, including Mid-America Angels, they do not charge anything for the entrepreneur to apply. And really the most significant cost the entrepreneur has to be prepared for is the fact that they're probably going to need to hire a securities attorney to help them with the necessary legal documents through the process. Well, I think the disadvantage is the fact that you're giving up ownership in your business. So, most angel groups, when they invest, they're looking for equity ownership in the business or, an actual piece of the business they're really not in the business of doing loans, like a bank. They want a piece of ownership. So the disadvantage is it's a fairly expensive type of capital. And usually at the early stage, the business is not worth as much as it will be later on. So you're having to give up a bigger piece of equity in the business in order to get the financing completed. Well, certainly the thing that I would recommend to any entrepreneur that's considering this process is to get help. Go out and talk to other entrepreneurs that have raised capital so you better understand what the process is like. Take advantage of the numerous entrepreneurial resource organizations in the area. Folks like the Enterprise Center of Johnson County, or like the Small Business Development Center located here at Johnson County Community College. There are a number of organizations that can give you some guidance and counsel around how the process works. Some of these organizations have workshops that you can go to. But the key thing is to get as much help as you can to make sure you are thoroughly prepared and that you really understand the process, because there are a number of places along the way that the process can kind of come off the rails if you're not fully prepared or fully organized going into it. So that would be my best advice.